Brad Thomas here with the Intelligent REIT Investor. I'm joined today with Scott Peters. Scott is the CEO of Healthcare Trust of America, ticker symbol HTA. Scott, it's good to see you today.
Good to see you.
Scott, you just announced this week a transformational deal, $2.7, $2.8 billion acquisition of Duke Realty's MOB portfolio. Tell us about it.
Well, it was a tremendous opportunity for us. We're going to be 24 million square feet in size. We're going to have an enterprise value going forward over $9 billion. But the most phenomenal thing about this transaction for us is that 85% of the assets that we were acquired in this transaction are in our markets. So we have been talking about core markets for the last 5 years. I think every time you and I have gotten together, whether it's been in Phoenix or at REIT, we've talked about what we think is core critical real estate, getting size and depth and critical mass in key markets that we think are gateway markets. And our view is gateway markets are academic university, higher employment, higher wages, good infrastructure, jobs moving to those markets. These are the markets. So what we got to do was in one big swoop at a very accretive cap rate, what we think is going to be over the next 3, 5, 7 years, we got to put, as you said, $2.8 billion of assets onto our platform.
Sure. So how are you funding this? I know you were raising equity. I believe I saw that this week as well. And your balance sheet's been in pretty good shape, but how is that going to impact you in terms of your leverage?
Well, we were very fortunate. Monday and Tuesday we went out with an equity offering raise. We raised $1.6 billion approximately. At the end of the process, there's some opportunities for some of the healthcare systems to buy some of the assets. There's a process that they go through where they have a right to buy some of these in the transaction. And we think that at the when it's all said and done, that we'll probably have a transaction of about $2.3 billion. We've raised $1.6 billion, so we've already pretty much right-sized our balance sheet. And this gives us an opportunity from an investment credit rating perspective. Size was really the next thing that we needed to accomplish in order to get upgrades with the credit agencies, because medical office buildings have such strong fundamentals. Maybe we'll talk about some of the strong fundamentals that come with this portfolio.
Sure. Well, also I want to ask you about that, because your asset class, I know the cap rate was in the range of a 5, a high 4 or 5 cap rate. But when you look at the asset sector today, the MOB space, compared to all the other spaces, you've got, skilled nursing's been under pressure, retail, the malls are under pressure. MOB has been this safe harbor asset class. So how would you relate to that in terms of the cap rate with this transaction?
Well, the cap rate, as you mentioned, we look at it as a 5, 5.25, and we'll grow it from there. Our benefit for us and why we were the most natural, logical buyer when we went through the underwriting was that, again, 17 markets. We have our own asset management platform, own leasing, property management, engineering. So this just flows right onto our platform. We had built this platform the last 3 or 4 years so that we would be able to grow $1.5 billion to $2 billion without any significant addition of any G&A that isn't passed through to the tenants or that isn't specific to the assets. And we did this now instead of over 4 years or 5 years, we did it all at once. Cap rates for MOBs are just, they continue to come down because of the stability of the earnings, the creditworthiness of the tenants, the strong occupancy, and then, as you know, the whole key to real estate is same-store growth on an annual basis. And both of these portfolios over the last 4 years have produced greater than 3% same-store growth. So you're taking 2 greater than 3% same-store growth portfolios, putting them together in markets that overlap with an asset management and leasing platform already in place. So the synergies for us was really the difference of what got us excited.
Sure. I've argued a lot that the MOB space compared to the pure office space has been underpriced relative to your office peers, to your larger office peers. So would this transaction actually move you in line with some of those office REITs in terms of your pricing and your valuation?
Well, I think that we're still not there yet. I mean, I know you and I've had this discussion going on now almost 2-3 years, where the fundamentals of the MOBs are more favorable when you look at the returns that investors get over a 5, 7, 10-year period. The cost of re-tenanting office is so substantial compared to medical office. Physicians stay, they renew, they get paint and carpet, and they stay. Healthcare systems don't move once they've established where they want to be. And again, you traditionally have paint and carpet, and you're good for 15, 10, 15, 20 years. So I think as we move down this path and as more and more transactions occur, MOBs get more and more recognition, you will see that cap rates do get to that point where they're comparable to office, and that's really the mid fours.
Right.
And we're not there yet.
Right.
And again, if you say mid fours are a good cap rate for medical office, then this was a really good deal for us.
Right. Well, let's talk dividend yields and really dividends paid. I know you've got a good track record now as a public company of paying out dividends. You have increased your dividends. You've been somewhat conservative in your dividends, but that's a good thing. So how do you think this is going to impact dividend policy? Is it going to be business as usual?
Well, we're going to continue to reward shareholders. I mean, we want to do two things. One, we want to take the cash that we earn and of course put it back into accretive acquisitions and build a company. But second, that's what real estate investment trusts do. They pay dividends, and this adds about $150 million of good cash flow to our income stream, and so this is a very good transaction for us. And we'll be moving our dividend as we continue to grow the portfolio. Again, this portfolio that we acquired, 93% occupied. It's 3% same-store growth on a historical basis, and we get to put it onto our asset management and leasing platform. So we think that we're going to get some very good accretion out of this from a cash flow perspective.
Sure. The last thing I want to ask you about is development. I know in the past you have the company has really stayed away from development. You've worked with a lot of developers, but you haven't actually developed. This Duke portfolio brings a new element to the mix. Can you talk about the development mix and how are you going to mitigate that development risk?
Well, first of all, now that we're of size, $9 billion enterprise value, there are opportunities in our portfolio that are pre-leased 100% with healthcare systems that we frankly, without this ability to utilize the technical expertise that now we're getting, would have had to be third-partied. We're going to be very disciplined. The investment dollars that we use for development is not going to go on spec development. It's going to be pre-leased. It's going to be with healthcare systems. It's going to be with credit, and it's going to have a timeline that's completed in 12 to 18 months. So, development is great when it hits, and you've got to develop to that 6.5, 7 yield, but you got to do it in a very efficient, timely, and very cost-sensitive manner. And so I think that's great for us. It gives us another tool in which to have conversations with healthcare systems. So we'll do, $100 million. That's what Duke has done historically, $126 million. And we'll probably do somewhere between 75 and 125, but it will be pretty much captive, meaning there'll be relationships that we've already had that we'll get to utilize where we would have not had to been able to do it in-house before.
And again, this is not spec, so you're going to have a large majority of this pre-leased.
It'll be all 85% or greater pre-leased. We're not in the spec building business, and right. HTA will not be doing that.
Great. Well, Scott, congratulations on this acquisition. I know it's a big deal for your company, also as a shareholder in full disclosure. It's going to be a big deal, so I'm really excited about that. Congratulations.
Well, thank you
very
much.